Many people will be interested to know how does inflation affect your stock market. If you have invested money in stock market, I guess by now you already know what the impact is, and we have seen the impact of high inflation in the stock market all over the world, not just in the US or Europe, but across geographies, across economies. We have seen stock markets doing very badly in the last many months now, since the war started in Ukraine. Some inflation is fine, like zero inflation is not good, because that indicates that economies are not growing. But higher inflation, like inflation of 9% in the US, indicates that the cost of borrowing will be very high for many companies, because the interest rates will be high. It's a negative thing for the economy. So economy is not growing, so people will not put their money in the stock market in buying stocks. They will not do that. So yeah, on the stock market, it's an adverse impact, right? And we are currently seeing that actually in the US and Europe. Apparently in India, it's not, the impact is not yet very significant, but we could see that also maybe in couple of quarters. It's also a bit subjective. Sometimes what happens is that there may be inflation, high inflation, but economies are growing, and in that case people will still believe in the stock market. So they might think that this is a temporary phenomenon and that will go away in few months time or few quarters time. So people will still go ahead in investing money, in putting money in stocks. But that's not the case right now. Economies are contracting. GDP growth is negative in many countries. So this is not a time. This is not a, this is more of a recession time, right? Although we are not technically in recession, right? A global recession. Maybe some countries are already, but most, prominent major economies are not yet in a recession. But it's not a boom time either, right? And in such time, if there is high inflation, then there is a negative sentiment, right? But sometimes also you have high growth and high inflation, like what happened in China a couple of like a decade back. High inflation, high growth. People were still believing in the stock market and they were putting money there. But this is a different time. All right. So what's the relationship between inflation and unemployment rate? It's an academic topic actually. I remember studying it in university. There's a famous curve called Phillips curve. So I think if you have taken some courses on economics, you might have already studied what is a Phillips curve. So Phillips curves tells you about the relationship between inflation rate and unemployment rate. Very simple to understand. You can see the curve in front of you, where you see that there is an indirect relationship, inverse relationship between inflation and unemployment rate. If there is high inflation, there is high inflation rate in an economy, you expect the unemployment rate to be low, and the vice versa. Okay, so that's Phillips curve, and the logic is also very simple. That if the inflation rate is high, it may be because of high growth. The economy is growing very fast, hence there is high inflation. And when the economy is growing very fast, you expect the unemployment rate to be low, because everybody is getting a job, so everybody has a job, so there's everybody is participating in the economy, so your unemployment rate is supposed to be low there. And the other way around also, right? If there is low inflation, so there is less growth in the economy, or the economy is not growing at all. In that scenario, you expect the unemployment to be quite high. So there's a trade-off actually. Okay, you want to control inflation, you will sacrifice employment rate, and it's also the opposite is also true. So that's Phillips curve. We have learned it, but there are exceptions also. There are times when you will experience high inflation and high unemployment rate. that has happened in the US in 1970s. We have seen that high inflation and high unemployment rate. That could also happen. It does happen in the world. It's called stagflation. Okay, it's a different kind of inflation where it's a double whammy to the economy, where you see pressure coming from inflation side as well as from unemployment side. Whether we will be having stagflation in 2023 is a question. Some economists are also thinking about it, and they've given the opinion that it could be the case also. In 2023, we'll have a stagflation, high unemployment and high inflation. We'll see the historical relationship. So here you see the inflation and unemployment rate in the US, and the data is taken from 1978 up until 2011. So about 40 years of data. You see that every time there is high inflation, the unemployment rate is somewhat lower, right? So there is a trade-off. So there is a gap, right? In most of, you see here, right, for most of the years you see a gap between the red and the blue line. That means, if one is the higher, the other one is lower. However, in the 70s, you see, even 78 to 1982, there was high inflation. Like inflation was like above 10%, 12%, 14% in 1980. But the unemployment was also more than 8%. In fact, it was 11% in 1983, when inflation was 11%. And unemployment was 11.5%. So that's a typical case of stagflation. Okay, but otherwise it's mostly a trade-off. It hasn't been experienced a lot, except in 70s in the US. In the UK is also you see the difference here. There is a trade-off. There is a gap between inflation and unemployment rate, right? And in the UK, there has probably never. This is the data from 2000 to 2015. Okay, 15 years data, not a long enough data. But you don't see stagflation also in this graph. This for UK. So I don't know if there was stagflation in the economy. Maybe this is an important question. I will check that in the internet. Yeah, we have already discussed about stagflation a bit, but just for definition, stagflation refers to an economy characterized by high inflation, low economic growth, and high unemployment rates. So that's the worst possible situation for an economy, where you have high inflation, economic growth is bad, so is the unemployment rate. So it's a typical scenario where there's a lack of supply of goods. So supply is bad, so prices are very high, and then the consumers don't have money to spend because the economy is bad, right? So it's bad in both ways. That means lack of demand and lack of supply. So the problem is coming from both supply side as well as the demand side, right? Doesn't always happen though, but sometimes we could end up in such scenarios. I was reading an article, actually. It was, I think, Washington Post, where the Fed's chairman, actually, Jerome Powell, right, at the moment, he has this opinion that we could have a stagflation and recession in the near future. Now, this has come from the Fed chief himself. So not a joke at all, right? You can go through this article actually if you want to, but it's interesting that this could happen. So bad times are coming. That's but don't always believe in the economic forecast. Sometimes they could turn out to be wrong. So, but no one can actually predict things. Certainly not in economy, right? It's so difficult to predict things in an economy, but it's likely that we would be in a recession with high inflation as well as with high unemployment rate. Now, how to control inflation? That's a $1 million question actually, right? It's I mean, there are some straightforward ways to control that, but you will have again adverse impact on the economy through different means. Okay, governments can control inflation through monetary policy, but monetary policies are formulated by the central banks, not by the government. So what the central banks like Federal Reserves and like central banks in a given country can do is that it can increase the interest rate. So because there is an increase in interest rate, very few people will be able to get loan or would like to take loan because the interest rate is very high. So the supply of money will be lower. It will be lower, because of which money supply being lower now will have an impact on the inflation because the prices will cool down a bit. But inflation could also be coming from the supply side of the goods also, right? In that case, it is somewhat less effective, although effective, but somewhat. Then sometimes reducing money supply. For example, in the pandemics, actually governments were giving money, direct money, like cash transfer to the people. And because of people have money, they can spend money, and they're not working also. Many people are not working because they have left the job, they have no job, so they don't want to work because now they are getting, money directly from the government. So that's the worst case situation actually. So factories are not getting people, there are vacancies, but they're not able to fill in the vacancies. At the same time, people are having enough money to buy things. So that is a typical scenario where prices could go off very high, and that's something happening. Sometimes government can have price caps, like government can come up with a regulation as to, okay, this would be the highest price for a given product. It was the case, I think, in the Nixon's time in the US in 1970s or early 80s. It didn't work actually. There's a good article on internet, you can read about it. The price cap, it doesn't help. And I don't think many countries, many central banks use that anymore. So the preferred way is to raise the interest rate. That's the best way. There's a very